Our next guest is sounding the alarm on stagflation. Economist Stephen Roach is former chairman of Morgan Stanley Asia. He's now a Yale University senior fellow. Great to have you, Stephen. So stagflation is your base case scenario. Why is that?
Well, Melissa, the stagflation scenario is something I wrote about 2 years ago in the FT, and I worried more about the supply side than the demand side. But now the demand side has really gotten away from the Fed, and the Fed has a massive amount of tightening to do. Not even the markets are not even close to discounting the full extent of what's going to be required to bring the demand side under control. And so I think that just underscores the deep hole that Jerome Powell is in right now.
So to the pundits and to the Fed officials who say that inflation has peaked, inflationary pressures would abate in the back half of the year, what do you say to them? Shouldn't that be something good that can alleviate that base case scenario?
You know, I think the peak inflation rate argument is sort of a cheap argument. I mean, you know, when you go up as fast as we have, as high a level or rate as we have, you know, peaking is sort of an arithmetic, obvious outcome here. The question is where we go beyond the peak. I think inflation is going to stay above 5% through the end of the year. That would be well above the nominal federal funds rate as discounted in the market. So we've still got a negative real federal funds rate, which is miles away from neutrality, if you want to call it that, that is associated with a more even-keeled monetary policy, and not even close to the restrictive policy that will ultimately be required to bring inflation down.
It's Karen, thanks for being on. So let's say that 5% inflation scenario is correct. If you're Jay Powell, how quickly do you get to 5%? Or somewhere? I mean, maybe you don't get to 5%.
I think you got to get there a lot faster, Karen, than the sort of 50 basis point increments. I mean, even if he does 50 basis points in each of the next 5 FOMC meetings in 2022, you know, the Fed funds rate ends the year at 3.25%, and again, that's still nearly 2 points below what I think the inflation rate will be. So 50 basis points doesn't cut it, and by ruling out something larger than that, he just sends the signal that his hands are tied, and I think the markets are uncomfortable with that conclusion.
Stephen, it's Tim. Thanks for joining us. The two sides of the stagflation argument you're making, I think, are only exacerbated by reorganized globalization, if I will. So the fragmentation of the global economy, the isolationism, I think adds to both sides of this equation. Put that in the context of the duration of how long you think we're going to encounter this.
Well, Tim, that's what led me to write this article on stagflation a couple of years ago. I completely agree with that. And, you know, I would add to that, of course, the zero COVID in China, along with the repercussions of the war in Ukraine. And that will, I think, keep the supply side, you know, well extended in terms of a clogging price discovery through the next several years. So that's why it's even more incumbent on the Fed to be aggressive on demand management to deal with this protracted congestion on the supply side.
Stephen, when you say stagflation is a base case, do you foresee that as being a long, will it hit the economy for a long time, do you think? Or is this the kind of thing where, you know, the Fed could actually eventually get to 5 and we get out of it? And that's 2023.
Well, I don't know, Melissa. You know, you never know how long these things are going to last. But we do know that monetary policy operates with a long lag. You know, as Tim just alluded to, the supply congestion is here to stay for the foreseeable future, and the lagged impacts of Fed tightening on the demand side are probably not going to play out full force until late 2023, 2024 at a minimum. And to the extent that the Fed stays cautious, we could be dealing with excess demand for even longer than that. So this inflation problem is widespread, it's persistent, and likely to be protracted. And so the Fed needs to take that into greater consideration in formulating its monetary policy strategy.
Stephen, it is great to get your thoughts. Thank you so much for joining us. We appreciate it.
Thank you.
Stephen Roach. Bonawyn, are we priced for stagflation for that scenario?
I don't think we are. I don't think you've heard corporate execs come out and address that issue. I don't think, despite the fact that we have had multiple compression, I don't think that you've seen that really priced into earnings, right? Like, we've had multiple compression. We talk about the two levers. But if you have a stagflationary type of situation, you're going to see the earnings part of that equation get ratcheted down. And until we start to see that, I don't think it's priced in.
Yeah, and I would say agreed wholeheartedly. And Stephen Roach knows more about all of this, you know what I mean? He's forgotten more than I'll ever know. I just don't see any way the Fed funds is anywhere near 5%. The last time it was near 5% was at 2007. And think about where the Fed's balance sheet was back then. And I get it, they weren't dealing with negative rates and they weren't dealing with inflation where it is. But the last time it was at 2.5% was 2018. And the stock market went down 20% in a straight line in 2 months. And what did the Fed do? They pivoted. So I just don't think that all of these people who, there's a lot of people, a lot of very smart people think rates are going much higher and they should be going much aggressively. And I think I heard Jim Cramer say he thinks that they should do an intra-meeting, 1% hike.
They should have done that before.
Okay, but what I'm saying is that now that we have the weakening economy, which is the thing that they're kind of trying to solve for, they run the risk of accelerating it dramatically to the downside. Europe is likely to be in a recession because of this war. China is obviously having a very difficult time right now, and we might not be far behind it. And you throw that R word out there with the negative wealth effect from the stock market going down, from housing that's clearly peaking and going lower, and rates higher, and then the spike in consumer credit that we've seen, it really does make for a nasty thing. I think the Fed, after they get done with these two hikes, they're going to actually have to be very thoughtful, especially if they're going to follow through with their QT, because they do run the risk of putting us into a recession.
I'm going to be yelled at by our producers, but I've got one question, Tim, and I'm wondering, do equity investors, would they react in a more negative way to a recession scenario or to a stagflation scenario?
Well, they're two different time horizons. I think stagflation is something that's unfortunately going to carry on for a long time. I want to see deep and severe. Let's get this over with, and I do think that that's what the market is calling for.